Identity theft in tax administration is simple. Someone uses a taxpayer's personally identifiable information, like a name and social security number, without permission to commit fraud. And it's not just individuals. Businesses can be victims too. On the EA exam, they love the definition plus the practical how it shows up part. Unexpected refunds, surprise wage items, or IRS notices that don't match the taxpayer's real life. PII misuse is the engine behind most tax identity theft. Think social security numbers, addresses, and anything used to authenticate a return or redirect money. Fraudulent refunds are a major issue for the IRS, so they treat odd refund activity as a big red flag. Exam tip: if a scenario includes refund, amended return, or address change, your brain should immediately consider identity theft. Employment-related identity theft is its own favorite exam topic. This is when someone uses your SSN to get a job. The tax impact is sneaky. The IRS sees wages under your SSN, so your transcript shows income you never earned. Then you get a notice proposing additional tax for unreported wages. If the employer is in a state where the taxpayer never lived or worked, that's a classic indicator. Now, the real-world amended return scam. Picture a business owner who gets an IRS notice about a big refund from an amended corporate return. He never filed it, he never signed it. The twist: a former bookkeeper files the amended return and directs the refund to her address. That's identity theft against a business entity, and it often involves stolen business documents and refund diversion. When you're looking for clues, think notice plus transcript. A notice might propose an adjustment. The transcript might show wages from an unfamiliar employer or activity the taxpayer can't explain. In employment-related identity theft, the transcript is often the smoking gun, wage lines that don't belong. In refund fraud, the notice about a refund or amended return is the trigger that something is wrong. Finally, the practitioner access trap. Even if you know it's fraud, IRS employees can't just discuss taxpayer details with you. You generally need a valid power of attorney, Form 2848, on file, and the taxpayer's identity must be authenticated before the IRS can share information about the fraud issue. On the EA exam, watch for answers that confuse a POA with simple disclosure consent. They're not the same thing. In which of the following instances is a power of attorney required? Is it allowing the IRS to discuss return information with a fiduciary, advocating for a taxpayer during an IRS examination, providing information to the IRS at an IRS employee's request, or authorizing disclosure of tax return information through written or oral consent? Think about it. The correct answer is advocating for a taxpayer during an IRS examination. That's representation. So Form 2848 power of attorney is required. A tempting wrong choice is authorizing disclosure of tax return information because it sounds official. But disclosure consent is not the same as a POA. A POA is what lets you act for the taxpayer before the IRS. Which statement is not correct about changes to powers of attorney? Consider these. After substitution, only the new representative is recognized. A taxpayer must authorize a new representative when revoking a POA. Delegation can be allowed if the form specifically authorizes it, and a representative can withdraw from a matter. Which one is not correct? Think about it. The incorrect statement is that a taxpayer must authorize a new representative when revoking a power of attorney. Revocation just ends the prior authorization. It doesn't require naming someone new. The tempting one is the substitution rule, because it sounds harsh, but it's true. After substitution, the newly recognized representative is the one the IRS treats as the representative for that matter.